What does the 2023 budget mean for property businesses? Hey, it's Chris here from Property Abundance, and in this video we're going to dive into the details for the Chancellor's budget that just came out today and figure out what are the changes that are coming in that will have an impact on the property industry as a whole, and specifically anybody trying to run a property business within this industry. So let's dive into the first thing. Well, the first thing is that they're saying that because of the changes that are being made, we are now forecasting that the UK won't actually hit a recession this year, which is just good news for a ton of reasons, okay? Now, look, recessions do bring their own opportunities. You know, when you've got a recession, you have demand at the bottom end of the market, which means you get a lot more HMO demand. But generally speaking, for business as a whole, recessions are not generally good news. So the fact that we're going to be avoiding one, or we're certainly forecasting to avoid one, I suppose nothing's ever guaranteed with this, but the forecasts say that we should avoid recession, which is going to be better for stability, better for investments. You know, if people are making more investments, both their business confidence is higher and people are making those investments and investing into jobs and investing into growth opportunities, then you just get a lot more stability in the market. You know, people's jobs are more secure. And when you're running a property business, that's really important because your income is tied to them being able to afford to pay for their accommodation, right? So if you have a situation where you get a lot of job instability, obviously that can increase defaults on rental payments. So if we have more stability in the market, if we're going to avoid going into a recession where people start to tighten their belts and start to make cutbacks in staff, we should expect more stability in the rental market and therefore fewer defaults and fewer people missing rental payments as well. So just adds a bit more security to anybody who has tenants, like a single let model or an HMO model where your end user is actually a living in tenant. Now the second one is the Office of Budgetary Responsibility suggested that inflation is actually going to plummet this year, which is quite a surprise to me. I didn't think we'd see such significant numbers in such a short time. But they're saying that by the end of 2023, they're expecting inflation to have shrunk to just 2.9%, which, considering right now it's like 10.5%, that's a huge reduction. I'm not quite sure what the plan is behind that, how that's going to happen. But the OBR is an independent body. They look at the budget, they look at the impact that budget should have on economies, and that's their forecast. So, you know, it's pretty reassuring. Now that's good because obviously less inflation means less spiraling costs. It makes running any sort of business far more predictable and far more secure because you can forecast what your costs are going to do. You can forecast what kind of salary increases you've got to pay your staff. You can forecast what resources are going to cost you to acquire. Now, when they're up at 10%, that gets a bit crazy because like trying to forecast that in gets a bit complicated. But when it's reduced, that gets more stable. But that does mean there is an opportunity right now that might not be around by the end of the year. Because investors, people with money, especially sat in their bank account right now, currently have a huge problem. And their problem is that every pound sat in their bank account is worth 10p less by the end of the year than it is right now. Because with inflation at 10%, if you've got money sitting in accounts, it is currently devaluing at a massive rate, at a rate of 10.5% a year, right? So for every 100 grand you've got sat there, that's cost you 10.5 grand to have that, just to have that money in the bank. So we're finding it kind of more easy than ever to get people investing in our projects, raising new finance, getting people interested in investing in our business, simply because people that have money need to put it somewhere that's going to create a return on their investment. But specifically, they need to try and offset this massive loss that they're making just through inflation alone. Now, there's not that many investments out there, certainly not mainstream. I mean, there's tons if you know who to talk to, but there's not many mainstream investments that will pay you like 10% plus. You know, maybe bridging loans if you do some private loaning to companies. But then obviously you've got the risk to factor in and how well do you know the company and how well do you know their project. So if we're looking at the mainstream investment hubs, there's not that many that are going to provide you a rate of 10% return on your money. So that means that if you can offer them returns of 7, 8, 9, 10% on their money, you become a really interesting source of investment for them. Now that opportunity is now. So if you want to learn how to work with investors and you want to actually get some sources of finance for your business to do property projects, to use other people's money to buy and develop property projects, make sure you like this video, comment below and subscribe to stay up to date with the latest tips and tricks straight out my own property business, one of which an upcoming video we have got is about raising finance for your business. So make sure you do not miss out on that. Otherwise, stay tuned until the end and I'll talk to you about how you can get some help right now if that's something you want to master right now. So that's the OBR. Now, the next one is the Bank of England. Okay, now the Bank of England control interest rates in this country. Now, one of the things that they have forecasted off the back of this budget is that interest rates will now flatten. Okay, up until now, we've been seeing massive spikes in interest rates. We're up to like 4.2% right now. Now, the Bank of England is saying that it will flatten and stay and peak at around about 4.25 before even maybe falling towards the end of the year. Now, what does that mean for property? Well, look, obviously this one is huge for property because most people have mortgages on their properties, whether you own it or it's an investment property. Even as an investor, you want to use mortgages because it allows you to leverage and use other people's money to buy and develop more property deals than you could ever do by yourself. So if the cost of borrowing is going to stabilize and maybe even reduce a little bit towards the back end of the year, this is really good for property. Now, there's two reasons for that. Firstly, greater stability and people knowing that actually interest rates aren't going to continue to rise the way they have been is really good for house prices. Because at the moment, so many people are delaying buying houses because they're just not sure whether they can afford it or not. Like right now, if you know that you can afford a mortgage up to 5%, but if it goes above 5%, you're going to be bankrupt, you're probably not going to buy that house. But now if we know for sure that the Bank of England is forecasting flattening and even reducing interest rates towards the end of the year, that gives a lot more confidence to the buying markets, people who are going to be borrowing money. Now, that goes a step further as well. So firstly, great for house prices, and we'll probably start to see a slowing, if not a reversal, of the house price decline that we've seen up until now this year. But it's also good for projects, and specifically it's good for buy, refurbish, refinance projects. Now, this is one of the acquisition strategies we teach at Property Abundance. It's one of the best ways to acquire property and be able to recycle all the money that you put in back out so that you have the money to do the next deal and the next deal. Now, the way we do it is we buy as low as possible, we add as much value as possible, and then we get the property revalued and refinanced on the back end to draw our equity back out. Amazingly powerful property strategy, amazing way to actually create hugely life-changing wealth, okay, generational wealth where you own the assets as well. Now, why is it good for buy, refurbish, refinance projects? Well, firstly, having a stable level of interest rates is really good when you're using other people's money, because typically you're either working with an investor, like a private investor, or you're working with a bridging company, and bridging finance is a whole nother ballgame, a whole nother source of finance. But if you have erratic interest rates, using either of these sources of finance can be a little bit more complicated because people want to factor in the risk, and therefore the cost of that finance can become more expensive because of the volatility and the risk that that introduces. So if we have more stability in the interest rates and in the Bank of England's base rate, that gives much more stability to lenders, i.e. bridging companies, who are looking to be sure about the money that they're lending out and that they're getting a good return on their investment and that their money is safe. So firstly, it's going to stabilize the markets, which could mean that bridging finance becomes a little bit cheaper. And secondly, if you've got this house price increase that we're talking about, or at least a stability in house prices, this is good for buy, refurb, refinance projects, because building a project in a rising market is obviously the best way. If you acquire it for 100 grand and you take 18 months to do the project, or let's say 12 months just to keep it to a year to do the project, and in that 12 months the price goes up by, 7%, then you know that even before you think about the added value that you've done, the actual work you've done in the project, the base price of the house will be worth 7% more. That's a really strong market to be doing developments in. So if we do get this opportunity where we might start to see a slowing in the reduction of house prices, maybe a bit more stability, maybe even start to see an increase in house prices again now that we've got some stability in that interest rates and we're likely to see inflation falling by the end of the year, I think we could see a return to positive house price growth again, which would be fantastic for a buy, refurb, refinance project. Now, if you want to learn how to do buy, refurb, refinance projects, so a single deposit can buy you as many houses as you want because you can recycle every time, make sure you stay tuned to the end of this video. I'm going to let you know how you can find out a lot more about that. Okay, so that's the Bank of Interest, and that's the interest rates, the Bank of England's base interest rate, and how that's going to influence it. Now, the IMF have had their say as well, the International Monetary Fund. Now, if you think back I think it's like a month and a half, maybe 2 months ago at a push, they were basically slating the UK. They were saying the UK is not a first-rate economy anymore. We have basically dug ourselves into a hole, and this was during the time of Liz Truss's premiership, the very short period, if you even remember it, where she was in control of the country. And she came out with a mini budget and basically just got slated, and she lost her job within like a matter of weeks. Now, back then we got slated. Now the IMF are saying that based on this new budget, the UK is now on the right track. Okay, so we are making responsible decisions. We're actually making good, logical economic decisions again, which is reassuring. You'd like to think that the heads of the country have actually got our best interests at heart. So it sounds like, according to the IMF, we're back on the right track. So that's always reassuring. Now, the next one that's going to have a big impact on property investing, specifically if you're in the business of service accommodation, HMOs, supported living, corporate housing, basically any accommodation model where you are covering the bills for your end user. So whether it's your tenant of your HMO or your guest in your service department or the company, the care company that's renting from you, whoever, you'll be very pleased to hear that the energy price cap is being extended. So this actually came out before the budget, but we're just reporting it now as the budget is out in its entirety. But the energy price cap is being extended. It will remain at £2,500. If you think back to, just the end of last year, we were talking about average bills being £4,500. You know, the price cap is now keeping that to 2.5, and actually Ofgem have gone a step further, and they are forecasting that the average bill in March will actually only be £2,000, so even below the price cap. So that's good news. That's good news. Especially if you're the one covering the bills. Now, this is going to be very welcome news to HMO landlords, to service accommodation landlords, to corporate housing landlords, to care landlords. You know, anybody who's responsible for paying the bills, you'll start to see, not only a flattening, but a reduction of our bills as we come out of spring into summer and everything gets a bit warmer, a bit lighter. That's very reassuring. And now that the UK has become so much less, or Europe as a whole, we should say, has become so much less dependent on Russian oil and gas, we're starting to see a bit of a better overall cost in wholesale prices for these commodities as well, which gets eventually gets down to the retail level. It has been a little slow in happening, but we are now seeing it, which is fantastic news for anyone paying those bills themselves. Other things that affect business as a whole, but obviously spill over into property business, corporation tax, sadly, is still set to rise to 25%. Okay, so that was brought in by the last government to offset the cost of COVID. We had to pay for it somehow. So that is being put up to 25%. It's a shame, but at least it's only a tax on profit, so you're only paying a share of what you actually make. But as an offset to that, Rishi Sunak and his government have come out with capex costs. Now, I'll be totally honest, this one didn't totally make sense to me at first. Now, what they've said is that anything that companies pay for equipment can now be deducted as a tax-deductible expense. But my immediate reaction to that was, well, it already can. But the difference is they're now allowing you to take it off your annual tax bill and take it off your corporation tax, rather than having to look at it as an asset versus a liability and deducting it that way. So I guess that's good news for all of us as well. It's just a bit more of a bringing forward of the tax relief rather than having to wait and do a claim. But that and the R&D scheme will continue as well. Now, if you don't know what the R&D scheme is, this is anything that companies spend on research and development within their business can be deducted and reclaimed off your tax bill at a later date. Definitely want to be making sure you check those out if you haven't done one yet. If your company is developing something, obviously if you're not developing anything, then you can't do it. Now within trade stays, we were able to do an R&D claim because we were developing this agency service, we were developing a national reach. So you just need to get a good accountant that's going to be able to give you some advice on exactly what can and can't be claimed to make sure you stay on the right side of HMRC with any claims you do. Because you don't want to get in trouble with them. They are not to be taken lightly. Okay, so always make sure that you get accountants' advice and stay on the right side of the tax teams. Now, hopefully you found this really useful. They are the main updates. Now, there's other stuff about fuel duty and the cost of a pint, which always seems to change by pennies. I really don't know why they bother. But if you found this really useful and you found it helpful to understand what this budget actually means for property, and you want to maybe learn a bit more about how you can get investors or how you can do these buy, refurb, refinance projects that I mentioned earlier, we are offering some consultation calls at the moment with a member of my team where we'll spend about 30 minutes on the phone with you. We'll get to know you, what you want to achieve in property, and we'll give you some logical next steps for you to take to be able to develop that further. So if you want to grab one of those, the link is in the description for this video. Okay, it's a 30-minute, no obligation consultation call with one of my team to get clear on your next steps, whether it be raising investment and making sure that you make the most of the fact that inflation's still really high and therefore investors or people with money have a big problem. They need to invest, and why shouldn't it be with you and your company? Or maybe you want to take advantage of the fact that, if interest rates are flattening and maybe even reducing and house prices are getting a bit more stable off the back of it, then you want to start doing some buy, refurb, refinance projects, but you want to get that right. So whichever it is, make sure you book a call with the team. Link is in the description, and I'll see you on the next video. Take care. Bye-bye.